You know, roughly 62% of Americans currently own stock. Looking at the S&P 500 index as it seemingly doubles every few years, creating an optical illusion that the financial markets are a democratic tool for wealth generation. However, that perception is completely and frustratingly inaccurate. Wall Street has a cold, predatory nickname for most people reading headlines, trusting subreddits, and chasing hype. They call you a capital donor. This cynical label stems from the structural reality that 75% of regular retail investors end up net negative, consistently liquidating their fleeting capital into the hands of professionals who already possess systemic advantages. This structural imbalance is stark. The wealthiest 10% of the population holds nearly 90% of the entire stock market, a consolidation of assets that makes it impossible for regular participants to compete without understanding the operational blueprint. Clearly, there is an optimized, calculated method regarding how wealthy people invest in stocks that bypasses the superficial gambling nature of the average person, moving from the basic foundation of compounding right up to the advanced, asymmetrical billionaire playbook. This is a cold analysis, moving level by level to decode why some investors consistently extract capital while others simply donate it to the operational overhead of the financial machine. We must start with the raw, depressing baseline of how regular people interact with the markets, understanding that, in order to grasp why the wealthiest 10% succeed, you have to dissect the predictability of the failure of the other 90. As stated, 75% of retail traders, defined as isolated individuals clicking buy on an app, will lose their principal in the long run. The predictable cause is they suffer from the cognitive bias that they can outsmart the market. They try timing their entries, pick explosive winners, and get ahead of complex algorithmic trends by trusting random anonymous entities on the internet, almost inevitably failing to realize that picking individual stocks without industrial infrastructure is statistically suicidal. The harsh operational truth is that most regular investors generate liquidity, buying rapidly when valuations are inflated by artificial hype, and selling instantly when controlled panic finally sets in. That is the transactional mechanics that makes them capital donors. They hold assets when they are toxic liabilities and sell them exactly when the smart money is eagerly absorbing them. But some regular people actually win, refusing to play the high-frequency trading game and instead focusing on the only math that statistically favors them: blue-chip stocks and systemic compound interest. This reliable strategy is built on purchasing tiny slices of massive-scale companies like Apple, Microsoft, or Coca-Cola, which serve as global profit machines with a decades-long history of surviving systemic volatility. Instead of constantly trading and burning transactional friction, everyday investors succeed by simply buying, holding, and letting their initial capital compound over decades. This isn't theory. Simply buying and holding a standard asset like Apple 5 years ago would have already doubled your wealth without lifting a single mental finger. But even this strategy has profound systematic vulnerability. When your entire net worth is concentrated in one single corporate entity, you are taking a single-point failure risk. That realization of concentration risk is why most rational everyday investors eventually move toward index funds and exchange-traded funds, or ETFs, which systematically eliminate concentration risk by letting you purchase thousands of companies all at once. Most individuals enter this diversified pool through tax-advantaged vehicles like a 401k or a Roth IRA, which provides a legislative edge that amplifies the returns of compound interest. Once a regular investor masters index funds, they often make the final move toward true diversification, spreading capital across differing sectors, geographic regions, and even asset classes. This isn't chasing maximum returns. It is structural insurance to smooth the inherent bumps in the economic cycle, ensuring all their capital isn't held in a single vulnerable asset basket. If technology stocks enter a multi-year recession, perhaps healthcare remains steady, and if the domestic market collapses, maybe the emerging markets absorb the impact. But this diversified approach, while stable, is where the average investor maximizes their operational complexity, and it only generates average market returns, which is fundamentally why the wealthiest do something else. This is where the real mechanics begin. The first move millionaires make is actually the same maneuver that destroys 75% of retail traders. They pick individual stocks, but the critical differentiator is the methodology. Millionaires do not chase noise on social media. They act with strategic, disciplined logic, identifying companies that are fundamentally undervalued, engineered for explosive multi-decade growth, or that provide consistent, diversified dividend cash flow. But even the absolute best stock pickers cannot predict black swan events, and that is precisely why millionaires focus just as much on minimizing risk as they do on maximizing return, introducing the high-complexity logic of derivatives and strategic hedging. They utilize structured option collars, a powerful two-step mechanism that protects a massive capital gain by trading away future upside in exchange for downside immunity. For example, if you hold $1 billion in a highly volatile stock right before a market bubble bursts, you buy put options, giving you a locked-in right to sell your stock at a specific price, guaranteed. To finance this costly insurance policy, you sell call options, giving away the right for someone else to buy your potential upside if the stock continues to climb. By utilizing this strategic arithmetic, a wealthy investor fundamentally gave up the potential to get twice as rich if the stock doubled, but absolutely guaranteed they would not lose their wealth if the stock crashed. When the systemic bubble inevitably bursts, they walk away with their initial fortune intact, while every unhedged retail investor is entirely liquidated. Millionaire investors also thrive on calculated risk through the sophisticated application of margin and systemic leverage, strategically borrowing massive amounts of cash using their existing asset portfolio as collateral. If your calculation is correct, you generate near double the profits, paying back the fixed interest loan while amplifying your wealth velocity. But this mechanical multiplier also means if your trade is incorrect, you lose double your principal. Because a large segment of wealthy investors are busy operating businesses, they move their capital into hedge funds. These are private investment firms exclusively optimized for high net worth individuals, which use advanced investing strategies including mathematical algorithms, operational shorting, and cross-asset correlation logic to generate positive returns in any market cycle. They are led by industrial-grade managers like Ray Dalio's Bridgewater Associates, which utilizes macro-systemic logic, placing massive global bets on interconnected economic trends, such as analyzing how complex changes in domestic inflation rates will impact corporate earnings in Europe months later, looking at entire geopolitical systems rather than individual stock tickers. And then there is quantitative trading. Quantitative firms, like Renaissance Technologies, rely entirely on hyper-complex mathematics, predictive code, and massive, raw data streams. They build and constantly optimize algorithmic models to execute thousands of trades per day, designed to exploit tiny mathematical inefficiencies that would be absolutely invisible to a human observer. For instance, one quantitative model might detect a probabilistic relationship that, whenever a specific index climbs by over 1.5% in the opening hour, it holds a 92% probability of dipping by the lunch hour, automatically initiating short positions. Another machine learning algorithm might systematically ingest global satellite imaging, processing hundreds of millions of data points, noticing that if monthly rainfall in the American Midwest drops by 2%, it generates massive systemic surges in fertilizer company revenue 7 days later. This isn't trading. This is probability-based financial manufacturing, running around the clock with machine decision-making that captures split-second probabilistic edges. And the returns are astronomical, with flagship funds generating 66% consistent annual returns, before fees, year over year, creating an institutional advantage that even most standard millionaires cannot access. You will clearly notice a terrifying pattern here. As the wealth bracket expands, the operational complexity and computational power move from compounding to predictive manufacturing. However, at a certain apex level of wealth, even a standardized hedge fund is functionally insufficient, which leads us to the final apex level of capitalization, the family office. This complete centralization of strategic command is how the actual billionaires manage assets. A family office is a dedicated team of elite analysts, systematic investors, tax lawyers, estate planners, and legal strategists, all focused entirely on optimizing the capital allocation and multi-generational security of a single ultra-wealthy family. The most important of these private architectural advantages is direct private equity, which means purchasing significant equity positions in private startups, explosive growth tech companies, or engaging in complete corporate takeovers before those assets are ever made available on a public exchange. This calculated gamble is that these private positions will achieve legendary 90 times returns when the company finally enters the public market. When a billionaire makes these initial bets on early-stage giants, it requires direct, elite connections and monolithic amounts of private, illiquid capital, a structural entry barrier that a family office guarantees. And just as critical is direct systematic tax loss harvesting, one of the primary mechanisms billionaires use to keep 100% of their extracted capital. When you sell an appreciated asset for $1 million profit, you are hit with massive taxes. But if you simultaneously sell a poorly performing asset that is down by an identical amount, that calculated loss systematically cancels out your gain. While normal people emotionally cling to their losing assets, hoping for a rebound, billionaires view them as immediate structural tools for creating tax efficiency. When executed by elite family offices, this calculated harvesting of negative events ensures massive reinvestment potential while giving zero capital gains taxes to the government. This final strategy might sound like a mythological abstraction, but it is real, entirely legal, and it is the single most effective structure ultra-wealthy families use to manufacture wealth velocity. It is called the buy, borrow, and die methodology. For instance, if you are a multi-billionaire who has held a massive position in a tech giant since its inception, your initial asset base of $10 billion is entirely illiquid. Because the second you sell that position to access the cash, you trigger a multi-billion-dollar capital gains tax. Instead of selling the wealth to use it, you treat it like an infinite credit card. You place that $10 billion of stock as collateral with a major bank and borrow a few $100 million against it at an extremely low, preferred interest rate. Because that borrowed loan is technically categorized as debt and not realized income, you pay absolutely zero income or capital gains taxes on that massive stream of liquidity. You then utilize that untaxed cash to acquire more assets, fund your lifestyle, or simply expand your industrial footprint. And the final stage is critical. Upon death, you bypass the final tax liability thanks to a legislative tax loophole known as the step-up in basis rule. This complex legal structure resets the asset's purchase price from its 40-year-old cost to its current fair market value, effectively erasing 4 decades of massive, untaxed capital appreciation in a single generation, skipping legal transfer. It is highly controversial and structurally unfair, sure, but it is the raw financial engineering that separates standard retirement planning from the maintenance of a perpetual financial empire. There you have it. That is the raw, cynical arithmetic of how wealthy people actually invest. The complex strategies we have decoded today are not optimized for how you get rich. They are engineered with industrial-grade efficiency for precisely how you stay rich.